Hey, this is Tom, and unfortunately, there's a lot of charlatans on the internet, especially in the YouTube financial education, and a lot of them are selling you these investment tools, and I want to say investment tools, which are basically stock screeners. And the stock screener, unless you haven't heard this term before, is essentially a tool for you to screen horrible stocks from good research candidates. Basically, once a stock passes the screening, it's eligible for you to actually start your research. Now, I'm going to teach you how to do a basic screening test, but there's many ways of doing it. There's a lot of different companies with different screener. Mostly it's free. But I'm going to teach you how to do your own screener real quick. If you look at a company, how to know if it's worth your time to research. So the first thing I want to take a look at is market cap. I want to make sure that there's plenty of meat on the bone. I don't like to deal with small cap stocks. At least you want to have 2-3 billion at minimum of market cap, but that's probably even higher for mostly the stocks I tend to look at. I do have some smaller cap, but I want to make sure that I'm talking about a liquid stock with a lot of action, a lot of meat on the bone. I don't want small cap. Now, the second thing I want to take a look at is what's the short interest. If it's in single digits, then usually it's okay for me. Depends on which industry. I mean, if it's banking, it's probably has to be below 3%. If it's a growth or a biotech or some sort of a startup level business, then 6 or 7% might still be okay. But if anything is in double digits, it's usually an alarm bell for me and I just step away. Anything in double digits means that a lot of people are shorting the stock, and shorting is quite dangerous. So if you have 10, 12, 13% shorting a stock, usually it's not a good sign for me, not interested. Now, the second thing I want to take a look at, it's what's their profitability. I want to look at the margins. What's the gross profit? If it's a SaaS business, I'm looking forward to anywhere from 70 to 80%. If they're actually making hardware, I want to look at, anywhere from 30 to 40%, sometimes even 50%, depends on which kind of business. But I want to mostly make sure that they are profitable operationally. I want to see a good EBITDA margin and net margin as well. So in this case, it's very different. Tesla, for example, has operating margins of 15% almost in the last financials, and they will be at 18% by next time. There's a lot of different aspects of how to look at this, but at the very least, you want to see profitability. And if you don't have profitability, you still want to make sure why. In some cases, it actually makes sense because the company actually is reinvesting the entire cash flow back into the business by paying more salaries and investing more in R&D. They're creating a lot of expenses. So it's not necessarily something that I would disqualify an investment on, but at the very least, I want to make sure that the margins are compatible with the industry. So if it's a SaaS, 80%. If they're actually making hardware, I want to see 30, 40, 50%. I want to see that there's anything there that actually piques my interest. I want to see a complete garbage dumpster fire. Now, the next thing I want to look at is growth. I don't want to usually invest in companies that are completely stagnant, even though they are printing cash. And I have a few of these, but mostly I want to see the company actually has potential in the future. Again, anywhere from 15 to 30, 35% is probably where you find the best deals. There's a lot of companies who are growing faster than this, and there's quite a few of them, but at that growth rate, there's still usually a lot of immaturities. Usually a more mature company that can give you like a 30% is actually a good deal. Google, for example, is a complete value stock with over 30% growth in revenues year over year. It's a prime example of why the stock is so good, why it's one of my biggest positions. Now, the next thing, you took a look at the short interest, the market cap, the profitability, and the growth. You want to take a look at the momentum of the company. Look at what the stock did for the past year. If it ran up like crazy, probably a lot of this upside you just found has been already priced in. So you want to be careful. But sometimes, you can miss on a good deal. That's the kind of logic I had with NVIDIA. NVIDIA had a massive run up. I got, scared and then ran up way higher and then I missed on the whole spike. So you just want to be careful with this. If the stock had a massive run up, you're probably, at the end of the line here, and you want to be really careful with that. Now, another thing I'd like to take a look at is if the company is actually paying dividends or not. If they are paying dividends, what exactly, especially with value stocks, you'd find dividends. With growth, not so much. In the banking industry, in the B2B industry, a lot of these value stocks, they do have dividends. Dividend is a really nice way to create cash flow for yourself through your portfolio. Not a bad idea. So if it's a value stock, I definitely want to see a nice little dividend yield. After that, I want to take a look at the revenues. How much revenues per year? I want to look at the multiple. What's the PE? I want to look at what's the price to sales. These two metrics are probably the two most important I want to take a look at. Again, if it's a value play, if it's a growth play, it's a completely different number. I'd say anything below 25, 20 for a value play is probably a good deal. Anything, if you're looking high growth, probably anything below 50. 50 is very high for a PE, but if it's a high growth company, sub 50 actually is within the realm of reason. You can look at companies like Snowflake, which Warren Buffett invested in, and he's insanely known as a value investor. So Warren Buffett invested in Snowflake, and I believe they have a PE of like 70. I don't really remember, or price to sales of 70. They have a very high ratio. So a high ratio isn't necessarily a bad thing if you're in high growth. After you look at the valuations and you compare the valuations to their comparables, I mean, if you compare a price to sales or a PE between a Tesla and the Ford, you're comparing apples to oranges. You got to compare the same company as far as the same type of company, because otherwise it just kind of skews your analysis. So after that, you look at what's the cash flow is. You want to make sure that you have plenty of free cash flow. Then you want to take a look at the balance sheet, and you want to see how much debt they have versus how much cash. You want to see that they're cash positive. Basically more cash than debt. Then you want to see that they have more liabilities, vice versa, more assets than liabilities. You want to see that they have a healthy way to repay their liabilities if necessary. You want to see that they're solvent. And when you take a look at this, make sure when you look at assets versus liabilities, you neutralize, you decrease goodwill from assets, because goodwill is an empty asset that's literally worthless. So when you decrease goodwill from assets, you compare to liabilities, you want to see you have more assets than liabilities. The bigger, the better. And in that sense, more cash than debt. But even if you have more debt than cash, but you have plenty of gap between assets to liabilities, that's still good enough for me. Again, just a few basic metrics. That's how I usually start my analysis. If at the end of the line, I look at all of these and I say, well, this is interesting, I'm going to dive deep into the real research. This is where the real hard work starts, which means looking at the business model, the total addressable market, what are the strengths, the opportunities, the weaknesses, what are the competitors, where this business is going, and your head will explode by that point. But I mean, 80% of the work is after what I just showed you, that little screener. But this little screener will weed out a lot of the trash you don't want to even spend your time researching.